Hello and welcome to another edition of BCR Webcasting. Today I'm very happy to be joined by Laura Saavedra Cruz, who's Director of Trade and Advisory and Structuring Supply Chain Finance at ING Wholesale Banking. Laura, welcome. Laura is going to be speaking at our Supply Chain Finance Summit, which will take place in Madrid at the end of January, 29th and 30th of January. Laura, you're going to be speaking on the topic of ensuring your ESG strategy is optimized, up to date, and successfully embedded into programs. So I want to ask you a few questions about that. Let's start with, how does sustainable SCF work, and what are the benefits? How do you balance suppliers with high and low ESG ratings, for example?
Thanks. So sustainable supply chain finance is basically a supply chain finance program enhanced with a sustainability angle. So as you know, supply chain finance is basically a working capital optimization tool that injects liquidity in the supply chain. So basically, our clients, buyers, are able to negotiate better commercial terms with their suppliers in exchange to access to SCF. Then, by adding the sustainability angle into the picture, this sustainable supply chain finance solution allows buyers as well to proactively manage the sustainability level of their supply chain by providing financial incentives to suppliers for their efforts to become more sustainable. How does it work? So basically, suppliers that participate in the program need to be assessed from a sustainability perspective. So, and then we link the pricing of the discount to the ESG score of the supplier. So we create a sort of price matrix where basically the more sustainable the supplier is, the cheaper the cost of the discount. So basically, the two main benefits that you see out of this solution is two: working capital improvements, and also this solution really helps clients with their sustainability ambitions. And maybe let me add also a bit more on this one to elaborate in terms of sustainability. I think it is very important to emphasize that one of the main indicators of the sustainability level of a company is how sustainable their company supply chain is. So by improving the sustainability of their supply chain, the whole sustainability of the buyer company improves as well. And given the increased attention in Scope 3, this is really a fantastic product or solution to incentivize the implementation of better sustainable practices through the whole value chain.
And how is this all incentivized? How are the buyers incentivized to provide better sustainability metrics for their suppliers? Why are the banks incentivized to do this? Because if you're giving cheaper pricing to better sustainable suppliers, your margins are weaker, aren't they? So what is the background to the incentive rule?
Well, for the buyers, basically, as I said, by turning their own sustainable supply chain more sustainable, they would become more sustainable. For the suppliers, because you will give them a cheaper pricing when they are turning more sustainable, that's incentives, right? A really financial incentive behind it. And for the banks, you're absolutely right. I mean, basically, we are decreasing our pricing, right? If the suppliers become more sustainable, but we have also our own sustainability targets. And we as a bank, ING really believes that sustainable business are actually better business. They over time, they have a more resilient performance. So this is also our preferred type of clients that we want to have with our portfolio. And of course, we want to support our clients in the transition to become more sustainable.
So this is the way forward. Presumably you want to scale supply chain finance ESG type programs. How do you go about doing that? How do you go about creating scale for these structures?
First of all, opening discussion with clients, and regulations are coming. So the common regulations really should help us out also with this one. But it's basically sitting on the table, discussing with our clients their transition plans, and seeing how we can help them out. And in terms of the supply chain, we have multiple, of course, type of sustainable solutions. But in terms of supply chain, this is one of the best ones, the best fits for our clients, sustainable supply chain finance. And then we would go client by client, see how is their supply chain and what is the best strategy to implement this for each client.
What do you what do you think the sort of timescale for this might be for you to get through to all your clients and implement this?
It's going to take time, a lot of time, and I don't know if even if we would get to a level that all clients would get there. I don't think so. This is going to grow little by little. But indeed, there are two approaches. Normally, I would say in all our new discussions with potential clients for supply chain finance, existing clients, but new, let's say, for this product, it's something that we discuss to understand their sustainability targets and discuss if this is an option, an interesting option for them to implement sustainable supply chain finance. And then for existing clients where we have a supply chain finance already, a program in place, then we also look, okay, is there an angle in here? Can we support you through this solution?
And when you look at the letters ESG, it's the E that people talk about most of all when we're talking about these structures. The environmental. What about the social and governance? To what extent is that understood? Does it need to be more understood? And what sort of weighting is being given on the S&G in terms of supply chain finance?
So I would say today the ESG, so environmental, social, governance metrics, are well understood because majority of the sustainable supply chain finance programs are connected to ESG scores. So basically, is third-party rating agencies are assessing the companies, and these external ratings normally include the three parameters. So yes, if the assessment is performed, to say so, by an external reputable ESG rating agency, it's going to be fine and it's going to be covered. That being said, we also see that programs that are connected to KPIs typically tend to focus more on the environmental KPIs. So we see, for example, that they include a decrease of certain percentage of greenhouse gas emissions, and then the S, social, the G, governance metrics are generally viewed as less relevant. On this regard, normally for KPI link facilities, ING recommendation is to add at least 3 KPIs, 1 KPI per each of the 3 pillars, environmental, social, and governance. So we make sure that we really cover the 3 areas and specific topics in the most specific or important topics for the client or sector that we are discussing with.
And you mentioned their rating or certification done externally by external agencies. What about doing that internally? How do you? Is there a possibility to set up and do that internally, or is external agents the way forward? What's your thinking about that?
Well, I don't see internal certification or internal rating or internal assessments models working for suppliers for now. Because first of all, banks are not really meant to play the ESG rating agency role, and again, there is a lot of at the moment there is a lot of lack of public data, of public disclosure of ESG data for suppliers. That's why actually using third-party rating agencies, they did really fill this gap and they provide a good service in that sense for now. Yeah.
Is there any differences or advantages in terms of prevention of greenwashing as to whether you use an external or internal system?
Well, indeed, in terms of greenwashing, I don't view internal assessment to be the best way to protect the market, but the opposite. Establishing clear definitions of the ESG factors to be assessed and standardizing the methodology of the assessment to the extent possible, of course, will create transparency and ensure that all external rating agencies will cover the same basics and principles, and at the end come with a comparable outcome on their assessments. So internal models would basically create the opposite, less transparency.
So let's talk about the sector in general, Laura. What do you see as the main challenges for corporates and banks in scaling ESG supply chain finance programs?
Unavoidably, sustainable supply chain finance programs bring more work than a regular supply chain finance program because next to the standard processes to implement a supply chain finance, with sustainable supply chain finance, suppliers participating in the program need to be assessed from a sustainability perspective. And often the required information for the assessment is not publicly available. So suppliers also need to be involved to provide their data and perform the assessment, which basically adds workload for all the parties involved. So also the assessment needs to be renewed annually. So it's not just a one-time thing, but really it's a annual exercise. So we are also updating our pricing accordingly if there is any change in ratings. Next to this, buyers or suppliers, or in some cases also the banks funding the program need to pay for the cost of the assessment and or to get access to the assessment, right? So I would say these two items, workload and cost, are the key reasons why until recently, unfortunately, not many corporates were ready or willing to push for sustainable solutions. And still the majority of the programs implemented to date are regular supply chain finance programs where basically the purpose is really, the purpose to implement such a program is basically working capital targets to meet working capital targets from our clients. That being said, market is changing and sustainable supply chain finance programs are really now quickly growing in demand. And I would say the most important and impactful factor for this is that thanks to governments and regulatory bodies that are increasingly imposing regulations to improve the sustainability in the value chain, this is changing. And very important here to mention, for example, is the EU taxonomy and the Corporate Sustainability Reporting Directive. This last, as you know, it's a regulation designed to basically to boost transparency and hold companies as well accountable for their ESG impacts. And the first level of disclosure, phase one, is basically taking place now, fiscal year 2024, and would impact about 50,000 large corporates. And each year, this reporting scope gets expanded and adds more on disclosure, more on companies. So this is very important. And in terms of supply chain finance, CSRD it's very important as it requests companies to assess and report their scope 3 emissions. And these are emissions from companies' supply chains, and these can contribute up to 80 to 90% or more of the greenhouse gas emissions, depending on the sector. So for example, for retails, this can be up to 98% of their emissions. So it is very clear that corporates have a major opportunity to reduce their environmental impact by working with their suppliers to reduce emissions through their value chain. And since from now on, scope 3 will need to be reported, then really sustainable supply chain finance can be a fantastic tool to provide these extra financial incentives to suppliers to help them becoming more sustainable.
Yeah. And I guess over time, and as you say, perhaps it's happening now, but pricing increases will become acceptable along the supply chain, right down to the consumers who understand the situation and understand the need to be more sustainable, and that's going to have an impact on pricing.
Right, for good and for bad, right? Because they also, if they become more sustainable, we would also improve the price, and so indeed, the less sustainable suppliers would be penalized. But indeed, that it would be the new norm in the future.
And we're very much looking forward to seeing you and hearing from you again with your fellow panelists. I think still one or two panelists that we need to get to join the panel, but yeah, we'll hear more from you in Madrid on the 29th and 30th of January at our Supply Chain Finance Summit. So thank you very much indeed for your time today. Thank you.
Thank you, Michael. Thanks. Bye-bye.